In this week's video, we're going to look at the recent sell-off in the bond market and the associated sell down in the property sector. We're going to investigate previous episodes and ask the question whether enough has been done within the property market. Just to have a very quick look at the actual underperformance that has occurred. Blue line is property relative to the ASX 300, and you can see the decline there after a long period of outperformance. The gold line is just a relative strength indicator with levels of 70 and 30 typically seen to represent overbought, oversold. So it's down towards the oversold level at the present time, which, as I said, begs the question, have we seen enough? And of course, that's going to depend on what happens next to bond yields. But in the next few minutes, I want to just look at sort of the performance of property trusts and their sensitivity to bond yields more generally. So what we're looking at here is previous bond market sell-offs. This is the 10-year bond. The shaded areas are the major sell-offs. So you can see 94, 99, 2009, 2013, and then this very, very small sell-off in bond yields that we've seen in recent times. So if we put that into the context of, say, basis points, now I'm looking at the basis point sell-off from the beginning of the sell-off in bonds in 1994, 400 basis points. The gold line, which becomes the red line, which is the average, was 1998, and that was a 200 basis point sell-off. The December 28 and 2009 sell-off was in the order of 160 basis points. The taper tantrum was around about 85 basis points, and the most recent sell-off, as we said before, around about 40 basis points. Very small in the overall scheme of things, but perhaps, if you look at it in terms of percentage terms, given bond yields are incredibly low levels, and this is important because it might give you an idea about the sensitivity and the duration of the market having increased with bond yields so low. So the sell-off in percentage terms is only surpassed at this stage by the 1994 sell-off. So that's just a sort of quick overview. So property has underperformed the equity market by about 5.7% in the most recent month in October, and by about 10% over the past quarter. In absolute terms, the REIT sector is down a little bit over 14% in the 3 months to the end of October, and yet bond yields have only risen by about 44 basis points. So how has the REIT sector performed in those previous bond sell-offs that we just talked about? Well, it's interesting to look at each of those events in isolation. The odd one there, I suppose, is 1994, where REITs actually performed slightly ahead of the market. But as we can see there, in every other period, certainly since 1998, the performance has been quite significant underperformance. So in 1998-99, REITs underperformed by 20%. That's the red line. Gold becomes the red in that instance. In 2008, underperformed by around about 22% at worst, or 23% at the worst point. In 2013, purple line underperformed by about 12, and most recently, as I said, underperformed by 10, and just improved slightly in the first few days of this month. So it's just comparing the relative performance to the change in the bond yields. One observation that we do make is that in the bond sell-offs, so per 100 basis points of sell-off in the bond market, property or REITs have underperformed by anywhere between 9 and about 25%. So the 9% ratio, 100 to 100 basis points, so 9% underperformance to 100 basis points sell-off was the 1998 episode. In the 2008 episode, the ratio was 12.5 to 1 roughly, meaning 100 basis points, 12.5% sell-off or underperformance in REITs. In 2013, it was about a 15 to 1 ratio, whereas market only sold off 80, but property underperformed by 12. And then most recently, as we mentioned, 10% underperformance with only 40 or 45 basis points on the bonds, so a ratio of closer to 22 to 25. So one observation from that is that the bond rate sensitivity of the property market in relative terms has increased, and that's probably not surprising given, one, where valuations have got to, but also the absolute low level of interest rates in all asset classes at the present time. Indeed, if we construct a very simple regression model of property sector performance relative to the market on a monthly basis, using the change in the 10-year bond yield, since we're doing it since 2008, so since the GFC period, what we get an R squared of about 0.23, but we get a beta or a coefficient of -7. So basically what that's saying is for every 100 basis points, we get a 7% change in profit trust. So if you had followed that as your indicator, then you might have expected a much a smaller underperformance coming out of property. In fact, you would have expected underperformance of around about 2.5% to 3% rather than the 5% that occurred in the month and the 10% that occurred over the past 3 months. So in taking sort of a longer term or a 10-year view, the sensitivity of the property sector in relative terms compared to bonds seems to be a lot less than what's actually happened in the more extreme bond sell-offs. As we said, the ratio is more like anywhere between 12 and 20 times rather than 7 times. So property has become a lot more sensitive. Just another way of looking at that is the correlation. If we just now look at the correlation of property relative performance to the 10-year bond yield, and we look at a rolling correlation. We're using 1 month performance on rolling 12-month periods. You can see the correlation has gone to a negative 0.9 almost. So there's a strong negative relationship between the two. So if we were to witness a further, say, 50 basis points upside in the bond yields up to around about 2.75%, what might we expect from property sector relative performance? So the model the simple model that we used before would suggest an underperformance of around about 3.5% using that coefficient of 7, which is shown here again on this chart, which just looks at the combination of 1 month change in bond yields on the X scale and the relative performance of REITs on the Y scale. And that's sort of where we sit at the moment, pink being the most recent observation. If, however, we consider the relationship between the two over the past 15 months, I know it's a smaller number of observations, but it does appear to be much more sensitive. In fact, it comes up with a coefficient of about 16, so it would suggest that a 50 basis point sell-off in bonds might produce an 8% underperformance. So perhaps the 3.5% based on 50 basis points might be a bit on the low side. It might be closer to 8% underperformance if we did have another 50 basis points in bonds. Of course, the performance of the sector was not only dependent on the sell-off in bond yields and how other sectors perform, but also the starting point valuations of the sector. So what we're looking at here is the PE for the sector during each of the bond sell-offs that we've been talking about. So you can see here on each of those, and in fact what it has meant, falling from 14.5 to 11.5, 15.5 to 12.5 here was already off a long way. Once again, from around about 16 to 14 and 18 down to sort of 16. So, you might suggest that the average PE contraction has been, well, the average is given by the bold red line, around about 200 bips. Has been the average going back in time. On a PE-rel market basis, once again, we're showing, say, from 98 onwards, what's happened on a PE-rel basis. So gone from 1 to, say, a 30% discount. Here it went to again a 30% discount to the market. Back in the taper tantrum 2013, went for a 10% premium to about a 5% discount to the market. So, you have seen quite significant de-ratings of the sector on the two biggest sell-offs of 99 and 09, and obviously a smaller one on this occasion so far, and also a much smaller one in 2013. So to finish up, REITs have sold off quite a bit, underperforming by about 10% in the past 3 months, and it's taken their relative valuations back from a modestly expensive, this is just in terms of PERL, modestly expensive back to in line with the market. On a price to book, they're also looking quite expensive. What does it mean going forward? Well, clearly that depends on the extent of the bond sell-off, but what we've tried to do today is just highlight the increased sensitivity of the sector to rising bond yields, and in the event of another 50 basis point bond yield, it would suggest that we could see a further somewhere between 5 to 8% underperformance of the sector going forward. Thank you.